So guys, let's go ahead and get going. What I want to do today is deal with any lingering questions you might have on the problem set. My guess is you got most of those out of the way the other day, but if there's more, let's deal with them. And then I want to go ahead and start to review again some of those time value structures that we talked about the other day. Value equals present value of the discounted cash flow plus present value of the continuing value. Walk through a little bit of some of the variations on continuing value themes like we did the other day. I'm going to be doing some repeating, of course. And then I want to look at moving from that, which is a set of decision criteria that we were developing the other day, right? Moving from that to thinking about this estimated value, which we are going to take as being synonymous with enterprise value. Okay, that's what we're estimating is enterprise value. Or that which one would have to pay to acquire all the rights to all the future cash flows. Okay? So I want to move from that enterprise value to thinking about simply the equity value in a company. So the common and preferred stock. And give you a method whereby you can determine what the actual common price per share, preferred price per share might be given its enterprise value and the rest of its construction. So at which point, we'll probably only have a few minutes left. I'll go through that Excel assignment that I told you was coming, that you'll have a week to work on, and we'll be done. Fair enough? Okay. So with that, talk to me briefly about any lingering questions that you might have with respect to the problem set. Please.
So on M, both those values for the firm are negative, and that's just because the G is...
Sorry, did you say on M?
Yeah.
Okay.
And that's just because G is greater than WAC, right? Like our calculated G is greater than the value we have for WAC.
Yeah, I believe so. Let me just look at it real quickly. Having a hard time connecting what you're saying with the M I'm looking at.
So the calculation you have for us for the second value that we are creating for, oh, I guess you just, yeah, so we use the same formulas we did to calculate the value of the firm, but we just use the calculated G of 11.56.
Okay, now I'm with you. I was looking at the comments or the question here about our G being equal to IR times ROIC. Okay, so now that you've calculated that, I believe you got a G from that calculation of 11.5%. And now you're saying that when you use that G, it yields a negative value in the continuation term. And that negative value is a function of actually a couple of things. The primary item is that we have G greater than WAC. And that then sets up a negative denominator, which sets up a negative value for the whole term. Unless, of course, you have a negative numerator as well. So let's look at this real briefly. So I think that the continuation term we're dealing with is no plat. Times 1 minus G divided by ROIC divided by WAC minus P, right? Okay. And remind me what our WAC is. Is it 9.4? I just don't remember off the top of my head.
6.98%.
So we're going to do about 7%. Okay? And we have a G at 5%, but we also have a G at 11.5%. Okay? And remind me what the ROIC is.
13.89, so 14.
Okay. Yeah, we'll call it 4. And Garrett or Mikkel, you guys were actually driving an issue the other day that is the same issue, okay? Well, in this case, if we're using 5%, of course, then here we have 5% divided by 14% So we have a value that's less than 1, 1 minus that value, we still have a positive numerator. And we've got then the WACC at 7%, 5% G, so we have a positive denominator, we're good to go, right? If we have then 11.5% here, but this one is still at 14%, we still have a positive value here, which means we still have a positive numerator, but we now have a negative denominator, all right? And so we set up a negative value. You're going to find that this construction of the continuation term or the KVD construction actually serves as a bit of a sensitivity test as well. And here's how. Let's assume for a minute that we end up with our 11.5% G, but what if we only had a 10% return on invested capital? That 10% return on capital doesn't sound bad, right? Okay. Well, if that was the case, now we have 11.5% or 11.5 divided by 10, so it's greater than 1, sets up a negative numerator and a negative denominator, right? Which is going to give us a positive value. Is that a real value or is that a spurious result? I think it's a result that you can interpret. I don't think you can take that number at face value, if you will, okay? Because it is kind of spurious. Because how is it that when you've got these negatives floating around that you end up with something positive? Okay.
Oh, wait, no, never mind.
It's okay. This is a little counterintuitive, right? I mean, I'm kind of working your head through a space here that doesn't necessarily make immediate sense, right?
So does negative value indicate that at that calculated G, the firm doesn't have the capacity to grow up that percentage in the continuation?
I think that that's one of the interpretations of it, okay? So if we come up with this negative value for the entirety of this term, it may be indicative that the term's not necessarily, or the firm's not necessarily sunk with a negative value as the answer would appear, but it may be that it doesn't have the capital to reach those goals, and so it will bankrupt itself without raising new capital, okay? Is it a problem to have a firm whose growth prospects are significant enough for it to need to raise new capital? No. No. If its growth prospects are significant enough, and I'm assuming then that growth and profitability are kind of going hand in hand. So we seek growth to obtain more profit, right? More cash flow. So if its growth prospects are leading to positive cash flows, then it's not really a problem that it may need more capital to be able to accomplish them. If its growth leads to swifter demise because its return on investment is less than its cost of investment, well, that's a whole different story, right? But if its growth is leading to positive cash flows and positive outcomes, then that it might need more capital isn't problematic. In fact, if you have a profitable enterprise and you can evidence to a marketplace that that profitability compounded by a level of growth can mean yet more profitability, is it hard to raise investment dollars? Not terribly. Oh, you might be able to raise them in the equity markets. A lot harder to get equity money than it is to get debt money, right? Or you might be successful enough or have a good enough story to raise them in the equity markets. So it's not necessarily a problem. But this serves as a bit of a sensitivity test as well, because you've got G on both sides. So when G is greater than ROIC, sets up a negative numerator. When G is greater than WACC, it sets up a negative denominator. What does that tell us about the relationship between ROIC and WACC? Does it tell us anything specific? It doesn't necessarily, but it reminds us of something, a condition that we'd like to see. ROIC greater than WACC greater than G. Remember I told you that when return on invested capital is greater than weighted average cost of capital, growth creates value. Well, that's not hard to believe. When return on capital is greater than cost of capital, we have some positive remainder, and making it bigger makes that remainder more positive, bigger, right? So that's not hard to believe. And I believe you might have been asking me on Monday if the WACC minus G relationship was important in and of itself. And I responded that I understand why you might question that and why you might think about that, because it is so prominent in some of our calculations. But I reminded you that it's part of an algebraic derivation of an infinite series of values and summing them, okay? And so it wasn't necessarily important in and of itself. But here, you see where it lines up with some relevance. So this is kind of the condition that we would suppose is realistic. Now, one of the things that is said here then is that we like to see a growth rate, again, this is our long-term growth rate, less than our return on invested capital. That's perhaps a more important relationship than the WACC and G relationship, really. Please, Gary.
Is that just so we can keep up and like not?
It's exactly what it's for. If your return on capital is less than your growth rate, you're going to need more capital, right? If your return on capital is greater, then it's through retained earnings and such, it's giving you enough internally generated capital to keep up. So I think it's a really good way of putting it. Keeping up. Okay?
Is there a specific relationship or like between G over ROIC? Because I'm still kind of fuzzy on that.
Well, it is, and it comes from this relationship right here. When G is greater than ROIC, then you set up a negative numerator. So you might have a wonderfully positive no plat, right? You may have some EBIT profitability minus your adjusted tax base that is huge. But if your growth rate is greater than your return on capital, it's going to set up a negative value in this numerator. And if nothing else, that's something you should be looking at and thinking, what does that mean? And I believe immediately what it means is we are going to have to raise more capital in order to sustain that level of income and profitability. Not a problem. It's a management issue. Now you know part of what you need to do, right? All of this is simply so that we can have metrics that we can use as a lens to help us understand the effective decisions we need to make in the firm, or help us understand some of the decisions we must act on, right? Some of the things we need to do in order for our firm to continue to operate satisfactorily. Does that make sense? Good. All right. Any other questions about the problem set? Okay. Good. So Kira and I were speaking a little bit after class, or sometime between last time we had class and now, and she commented that the value equals present value of the discounted cash flow plus present value of the continuing value was something that I had shown you briefly prior to Monday but hadn't spent a lot of time on. And if that's the case, and my guess is it may have been, I apologize. You'll remember me saying that I've had two classes that are right at about the same point, kind of doing this right now, and so it's a little bit hard for me to remember which one is where, and I think I may not have spent enough time with you guys there. So I want to come back to that, we're going to rehearse it again, and then we're going to move forward with some of the construction. Fair enough?
Yep.
Okay. So remember that the value that we're calculating is some value at time 0, and it's going to be essentially synonymous or equal to what we would think of as enterprise value, okay? And it's the present value of some discounted cash flow plus the present value of some continuing value. And I told you that really the only difference you're going to see in the valuation models that we will examine is the continuation term tends to differ one to another. But the explicit periods, present value of the discounted cash flow, is pretty much the same for all of them. We're using the present value of the sum of some free cash flows divided by 1 plus a discount rate to the power of t during an explicit period of time. So Mason, when I say explicit, what do I mean?
Explicit and
Alex, what do I mean? Can you help?
just like the previous value, like the actual, what was the question again?
So when I say explicit or explicit period here, what do I mean?
In the future, right?
Well, that would be the continuation.
Oh.
That would-
It's now.
I
Garrett?
just mean a defined period of time.
A defined period during which I have explicitly forecast the cash flows. I'm not generalizing, okay? When I move into the continuation term, which is going to take all the rest of time and whatever, now I have to become very generalized, right? I can foresee a cash flow in 6 years, but since that whole infinite series includes 198 years from now, I can't see that very well, so I get extremely general and conservative in its estimation, which is why we tend to use a relatively modest G for that, okay? So here, we're looking at cash flows, and predominantly we'll be looking at free cash flow during some explicit period, so we've specified the time frame, 1, 2, 3, 4, 5, whatever it is years, and we have expressly or explicitly forecast each year's revenue, each year's expenses, each year's capital requirements, and that then lets us expressly or explicitly forecast each year's free cash flow. And we're going to get to forecasting, I don't believe it's next week, I think it's the week after, okay? That's the explicit period. What do I mean by continuation then? Well, it's everything that comes after the explicit, right? Sometimes the continuation term is referred to as the terminal term or terminal value. There's numerous ways of looking at it. I have numerous terms. Excuse me for that sentence. So the continuing value, when we're using the free cash flow model, is equal to the free cash flow at time 1 divided by WACC minus G. Now remember that WACC is simply one of the particular forms of a discount rate. We could be using other discount rates. When we want to look at the value of an asset from the standpoint of the firm, which is most often what you're going to be doing when you're making decisions in the firm, you're going to look at the firm's cost of capital, weighted average cost of capital, okay? If you're making an investment decision, you're going to be looking at it from the standpoint of the investor. But if we're making operational decisions inside the firm and trying to see how those decisions affect our stakeholders, our existing stakeholders, we're using the firm's cost of capital, because that is the investor's cost of capital as it's translated through the firm that they own stake in, right? That makes sense? Okay. Well, we have talked about a few different forms of free cash flow, of course, and you're going to find that when we're looking at a continuation term, that they all follow a relatively similar pattern. There is some cash flow or cash flow-like instrument in the numerator divided by a discount rate minus a growth rate in the denominator. So probably what we're going to find is it's principally this numerator that changes from one model form to another. Principally. There's one exception to that when we get to the market multiple model. Okay? Well, that then sets up a continuing value, which leads us to then the present value of the continuing value being equal to the continuing value divided by 1 plus our WACC to the T, or our discount rate to the T. It's important to remember the construction of this discount rate and all this period of time stuff we're dealing with. So if I'm looking here at my explicit period of time, the period of time for which I expressly forecast revenues and cash flows to get some cash flow value. I start at time 0, and time 0 is now, right? Now I go time 1, 2, 3, 4, whatever I have. And let's assume for a minute that I've decided that I'm going to use a 5-year explicit period. Well, I still have the next year, but that next year is time 1 in our continuation term. So time 1 in the continuation term is the year after the end of the explicit period, which then means that the year before it is time 0 in the continuation term, because 0 comes before 1. Okay? So when I talk about continuation value at time 0, I'm talking about this time 0, not this time 0. It's a huge difference, which is why when we calculate the continuation term, we then have to discount it back to today. You might say, well, wait a minute, if it was a continuation value at time 0, that's already discounted back to today. It's not. You have to think about the funky nature of this time signature. Time 0 in continuation lives somewhere out into the future. And we have to take that and bring it back to today. And we're going to discount it using an exponent that's going to be reflective of the last year in the explicit period. Can you see that? So, here's something to think about at the same time. We know that this term here in my continuation really is the sum of some free cash flows divided by 1 plus a discount rate to the power of t. And I'm using W and R, or WACC and R interchangeably here because WACC is simply one of the forms of a discount rate. Okay? And we know that it's simply this equation when we have an infinite series of values. And when this cash flow variable is growing at a constant rate in perpetuity, which is why we assign a fairly modest growth rate, because it's in perpetuity, okay? And it's going to become exponentially compounded. When that's the case, this equation simplifies algebraically to this blue equation above it, which is the good news for us, right? Because this is a bear to think about calculating otherwise, because every time we think we're done, somebody says, but there's one more, and there's one more. You can't calculate an infinite series of values by literally adding them up. You have to find the algebraic derivation. Okay? So we know that that growth rate is constant in this construction. Do we suppose the growth rate of the cash flow during the explicit period is also constant? Well, we suppose it's not unless we're told that it is. Okay? Think about this. So Zach's company is on schedule to produce $1 million of positive free cash flow next year. The year after that, it might produce, maybe expected to produce $1,100,000. The year after that, we expect there to be some softening in the market, or maybe you're going to start into some R&D. It's going to use up some of your cash flow, so it's only going to be $900,000. We're going to have some non-constancy, right, in a real business. I mean, I don't know the real business that has a constant free cash flow or even revenue line, or constantly changing. okay? However, if we don't know by having expressly or explicitly forecast every revenue and every expense based upon the conditions we expect to find in each of those separable years, if we don't know, we might generalize a little bit. We might say, we have every reason to believe that to expect a 13% average annual growth rate in our cash flow variable for the next 4 years. Now we know it's going to be 15% in the first year, 11% in the second, 13% in the third, whatever, okay? But we believe it's going to be 13% on average, let's say. Well, that lets us, without having expressly forecast every one of those years, it lets us kind of generalize what they should be. Does that make sense? And I think we looked at an example of that when we looked at some of the decision criteria spreadsheet the other day. Okay? That's it. And that decision criteria spreadsheet was that multi-columnar way of looking at the cash or the valuation construction. We're going to look at that again today. Okay. What if, however, the rate of growth expected during the explicit period is equal to the rate of growth expected in the continuation period? So what if the rate of growth expected in the explicit period, on average, is exactly equal to the expected rate of growth in the continuation period? In that case, is it necessary to separate these out? It's not, is it? Because if we have a constant changing rate of growth, or constant rate of growth, we can embody the whole thing in this one equation, right? Such that value at time 0 becomes our free cash flow at time 1 divided by WACC minus G. Why don't we simply default to this simple form? Because I'm telling you right now, this is a lot easier to calculate than anything that this looks like, right? I got 3 numbers. Interact them, I'm good to go. Why don't I do it, Mikkel?
You usually want to be conservative when you're looking in, like, way far into the future.
Okay, I know that this is going to take me all the way through and past the edge of time, sort of thing, right? So I want to be relatively conservative with that. But I got to couple that with something else. Please, and then Greg.
I'd expect if you actually do the calculation with the DCF and the current value, would you get a way higher number if you separate them, even though the growth rate is the same?
That's a good question. So what he was asking is, and correct me if I'm wrong, if we're supposing that this period has a growth of 13% and this period has a growth of 3%?
No. So if both has a growth of 3%, and I do it that way with the DCF and the current value, wouldn't that value be higher? If you actually do the math for it?
So let me think about this.
So you're saying
if
that,
my growth rate is low at 3%,
so you're saying if
Yeah.
G is equal for the DCF and the current value,
Mhm.
value in year 0 equals free cash flow over back minus G, right?
Okay.
But if you actually do the calculations for present value and current value with the same growth rate, and you combine them or plus, wouldn't you get a higher value?
I think so. So let's look at why that would be. So if G is higher, but still not greater than WACC, let's say, let's give it that condition, okay? If G is higher, then the value of our denominator becomes smaller, right? If the denominator is smaller, but the numerator stayed constant, the terms value expands, right? Terms value is greater. That's what you're saying, right? The way you explain it out, right? Are we together?
No.
No, we're not. How come?
So you're saying that value 0, if G is equal for DCF and CV, right?
Okay.
It's just equal to the free cash flow over back minus G, right? Because then you don't need to go the long way because you have the same growth rate for both periods. That's what you just said, right?
If you have a constant rate of growth of your cash flow variable during both your explicit period and continuation period, then you can use the one equation.
Yeah.
And you're saying if G is constant and small,
for both periods.
Right.
In an equation format that you just could use just to one equation, but if you end up using both equations, using the same G, wouldn't that number be higher?
No, as it turns out, if you use the same G for both,
Yeah.
you'll get the exact same outcome as if you just use the one.
Okay.
In fact, I think I can show you that in a few minutes when we go to the spreadsheet. Okay? Yeah, so if the G during this period and the G used in this period are the same G, and you calculate it using two different terms, it will give you the same outcome as if you calculated it with the one term. I'll show you that in a few minutes. We'll see. So here's the point I'm trying to get to, and I apologize for not having completely understood what you were trying to get at a minute ago. The point that I'm trying to get to is it's possible to do this whole thing in just one little 3-variable equation. Why don't we? Well, the reason we don't is it's very bold to say, I know what the growth rate's going to be, and that it satisfies my need for strong growth and my need to not have an unrealistically valued term. Because if I have a big G here, and this becomes a small denominator, this becomes a big number, right? Okay? So it's a very bold assumption. So we typically have to separate our assumptions. We can be bold in the short term because we probably have some legs to stand on. We have a reason to believe. Cure is the CEO, strong rate of growth, great financial management. Okay, we have a reason to believe we're going to be very successful in that period. But 37 years from now, we have a lot of hope. And we're just hoping the hope's not audacious, right? Does that make sense? That?
This is like an application question.
Yes.
When we're valuing a firm or valuing a company, is this just considering stable market conditions when we're looking at growth? Like,
No, that's a really good question. I would say you should not assume stable market conditions. Now, it's hard to make that assumption and have it visible for our continuation term, which is dealing with forever, right? But it's not hard to do it in your explicit period. We're going to get to a point where we start to forecast revenue and expenses. And I'm going to show you ways to think about that. We're going to discuss how we do it in spreadsheets where you can apply different rates of growth. In fact, here we are in year 11 of an economic expansion following the financial crisis, right? Year 11. That's pretty strong. That would suggest that the likelihood of an economic slowdown increases every year that we don't have one. Likelihood and reality could be two whole different things, right? That increases the likelihood. So if I'm forecasting today, and I'm forecasting for a 5-year period, I gotta tell you, I might forecast this next year strong. I might even forecast the year after that as strong also, but I'm probably then going to start hedging my bet because the likelihood of us seeing a slowdown in the next 3 to 4 to 5 years or maybe 12 months increases the further we go into an expansion, right? So I think you have to build those in.
and so when we're forecasting, are we forecasting our cash flow or are we forecasting a growth rate?
Well, good question. We're forecasting when we're doing explicit forecasts, and again, you'll see this, we're getting a little ahead of ourselves. You'll see we'll expressly forecast our revenues and expressly forecast our expenses and our capital requirements,
So
which will then forecast our cash flows. So I'd like to say we're forecasting cash flows, and we are, but that's a byproduct of what we're forecasting. But it is the byproduct that is the motivating factor of why we're forecasting.
So it's like forecasting our financial statements that everything else is.
It's not like them, it is them. It's exactly what you're going to see us do. Exactly. Line for line. Okay? Please.
So another application question. If you live in a country that has a little bit different monetary policy and you actually expect like a 3% inflation forever, would you calculate that into the WACC always? So if say you have a WACC of 10% and you expect 3% inflation, would you then put your discount rate as 13% then instead? Or would you never think about?
No, I think you always think about discounting of money. You're going to have to expressly build it in either to your expected revenue growth and expense growth, right? Or you're gonna have to build it into your discount rate. I think though, that most of us think in nominal terms when we're thinking about our discount rate. I can regularly expect a 9% return on my investments, okay? And I'm not saying that I can, I'm just saying that's an assumption we're making. Well, we don't tend to think in real growth, we tend to think in nominal growth. So I think you'll more often find that when it's built into your revenue growth expectations. But you've got to recognize that if you have a discount rate of 9%, and you have a 3% inflation expectation, then your real discount rate's only 6%, right? Yeah. So you got to know the economist in your brain. Okay. Okay. So let's kind of move forward with this. So this is the present value of the discounted cash flow. Present value of the continuing value sets up the need to create a continuing value. We know what that would look like if we weren't using a simplified form. We don't like it, it's ugly, we can't calculate it. We can calculate it this way, it sets up our value. And if the growth rate of our cash flow variable is expected to be constant during this entire period, starting now and going forever, which is a very bold assumption, and I think error prone to the max, then you could just use this one equational form. You're going to find when we start talking about multiples that when firms or analysts simply assess the value of a firm based upon a multiple and say, well, this year's EBIT or EBITDA is X, we apply a multiple to that, so the firm's worth Q, that they are using this kind of a format, and it's a very bold assumption and error prone. And the vast majority of investors and analysts do it. Why? And you watch the Shark Tank, right? When O'Leary says, well, you put a 7 times in this, that's what they're doing. Why? Why do they do that when we know there's so much more accuracy to be found by not doing so? Please, Bert.
I don't know if it's the answer you're looking for, but I kind of have heard something similar where a lot of people, when they invest, they do that growth rate, which sure it's not accurate, but they're assuming that's going to stay the same for them to recoup their money over a certain period of time. So it's kind of like an easier, lazier way for sure. But what I've heard is like, okay, I'll get my money back within 5 years. The growth rate should stay the same for 5 years, but sure, in 20 years it won't be the same. So they don't worry about that. But that's just kind of like...
No, you're right. I think a lot of it
lazy,
is
quick.
just maybe being intellectually lazy, if you will, but there is something behind it. Is it typically a representative of the firm that values their asset that way, or a would-be buyer that values the asset that way? It's a would-be buyer, okay?
So you're saying that using a multiple is less accurate than using a DCF?
If you apply the multiple immediately and have no explicit period to consider. If they're just saying, well, here's the EBIT from the base year, or maybe here's the EBIT that we're expecting next year, or EBITDA, whatever it is, and let's apply a multiple to that, we're good to go. And not having done any additional work. So Brigham's right, it's the easier way, might be the intellectually lazy way, but I'm not sure that it's unfounded in its laziness, okay? Think about this. Garrett, you're sitting there with Mark Cuban and whatever his name wonderful was, okay? Yes. And you apply this. You're a buyer, right? Do you want to buy at a high price or a low price? You want to buy at a low price, right? So you're probably using a relatively modest multiple. Why is that? Why do you use a modest multiple? Well, you use a modest multiple because you want to buy at a low price, hoping that it'll do better. You're going to get a big economic profit in the middle, right? That's what you're looking for, a big gain. Yeah?
I was just gonna say.
Okay? But think about what's happening algebraically. When we say that we're using a multiple, and it's a relatively modest multiple, which they always use, right? And it begets a small value. What's that saying about what they're assuming for growth in order to justify that value? If G is small in comparison to WACC, and if this cash flow variable isn't changing, it's just whatever, just where you were saying that is whatever it is. If G is small in comparison to WACC, then this term is going to be bigger or smaller than bigger, right? If that's, no, smaller, excuse me, smaller. Because when the denominator is larger in the face of a constant numerator, the value of the term is smaller. So they're using a relatively small growth rate to base their assumption on. The seller, the optimist, the entrepreneur, they want to use a bigger G because they're sure it's going to be more growth, and if it's more growth, it's more valuable. You can see that because when G is larger, then we have a smaller denominator, and the value of the term becomes much bigger. So keep that in mind. And this actually is part of what I think you were trying to discuss a minute ago as well. So keep that in mind. Okay? All right. So let's go ahead and let's take a look at that spreadsheet again now. And actually I've given us a slight variation on this theme. The spreadsheet that I was showing you the other day, if you go to the Excel templates link, which simply takes you to richardhaskell.net into the Excel template section, you'll find it in that, and it's called decision criteria.
It's just.
Pardon me? So there's a link on the front page of Canvas, on the first page of Canvas for you, says Excel templates. And if you go to that, it takes you to a particular website of mine that has a bunch of stuff on it.
Great name.
Pardon?
Great name.
Which one?
richardhaskell.net.
I am, okay. Well, I'm kind of partial to it, but kind of who cares, right? Okay, now here's what I showed you the other day. I kind of want to start here, and then we're going to move to talking about how we think about value of equity. Let me see if I can't make this thing bigger still.
Nickel.
Okay.
What's the name?
richardhaskell.net.
So remember the multi-columnar construction. In this column, in years 1 through the last year of the explicit period, we're simply putting the cash flows that we have forecasted for the firm during the explicit period. How we forecasted them is yet different, right? We're simply putting those numbers. Alex, do you recall what's in this column, the second column?
Yes, present value, cash flows.
Good. You either got a decent memory or you can read well. That's good. I like both of those things, okay? How do we get to this, Kira? How do we get these numbers?
Present, you just discount it?
Yeah. So we're taking whatever number is in this column, and we're dividing it by 1 plus the discount rate to the power of the number of years between now and then. Okay? So it's a discounting formula, exactly as you've learned to do. And then in the third column, it's simply a summation column, such that if we sum up these present values of these cash flows, we get the present value of the discounted cash flow, right? Which is our term for our explicit period. And then I drop down a little bit, and I then create my continuation term, which, exactly as we've suggested, is simply the cash flow in time one. In fact, let me do this and make it a little easier for us for a few minutes. I'm using decision criteria. The Excel template titled decision criteria. So in this cell, I simply have the expected cash flow in time one of the continuation divided by the discount rate minus rate of growth. Exactly as we suggested that the continuation term should look. Cool?
Excel question, when you click on the cell like that, how do you make it show the components that are making it up?
You can either double click the cell or you can click on it and hit F2. Either way. And that's in the PC version. The Mac version, I think, operates a little bit differently.
Just double click.
Double click it? Okay, all right. And I apologize, I don't speak Apple very well. I speak iPad and iPhone, but not Mac. But I speak PC okay. All right? So I've now created the continuing value, and in the next row, I am discounting the continuing value back to today by taking the continuing value, dividing it by 1 plus the discount rate to the power of the number of years between now and the end of the explicit period. And that then puts it in today's value, and then I can sum the two of those, and it gives me the present value. What's the difference between present value and net present value? Conceptually.
The discount rate?
No, discount rate's constant between both of them, sure.
Net takes out your cost.
Net takes out my cost. Think about the concept of net. We're netting out. We're taking something out of it. It's what our cost was, what our investment was, right, to give us the net present value. Okay? So why do I show this and construct this in a multi-columnar form? Why don't I just do it nice and neat in one Excel cell? Because I can put a formula that'll take this whole thing just in one cell, can't I? Why do I do it in this multi-columnar form?
It's more clear to see how you have growth in recent years.
Yes, and for my purposes, it's more clear for you as you're learning about this to see it, okay? I don't know that I would necessarily always do it this way if I were doing a valuation that I was showing a client. I do it like this because I think it makes it a little easier for you guys to see what's going on. And that's the only reason I do it that way, okay? And that said, there will be times when I will ask you to do it the exact same way, and I expect you to do it that way, okay? All right. So that brought us to our present value, and then I've got a whole different column set up over here to help us calculate net present value and such. Please, Gary.
Can you cover a little deeply, or a little like deeper, how to calculate the present value of the discounted cash flows?
Yes,
That
absolutely.
equation is still a little fuzzy to me, like I don't
Okay.
understand why it wouldn't just be like.
So there is a formula. Present value, you'll remember this from even Business 101 perhaps. Present value equals beta t divided by 1 plus r to the t. Indelibly etch it into your cortex. Present value equals beta t divided by 1 to the t, which means if I want to know the present value of any number, that number is beta t. I'm going to divide it by 1 plus whatever my discount rate is to the power of t, t being the number of years or maybe periods between now and the moment that that number lives. So in this case, I have the present value of my continuing value. And when we look at it, I've taken the continuing value, which is E37, the continuing value, divided by 1 plus the discount rate, which is just one row above what we're looking at, to the power of 4. And that's discounted this number at that rate for 4 years. Because this number lives 4 years from now. Okay? So just kind of etch into in there for yourself The discounting structure is whatever the number is in the future divided by 1 plus my discount rate to the power of the number of years between now and that point in the future. That's how we discount them. Okay? And when I have them here, Garrett, all I'm doing is taking this cash flow and dividing it by 1 plus the discount rate to the power of the number of years that this cash flow lives in the future from now. I do that for every one of these, and then I'm simply doing a running total such that this number at the end of the running total is the total of all of those. That's the present value of my discounted cash flow.
For the explicit period.
For the explicit period. Exactly, Zach, because this is the explicit period only, and the present value of the DCF is always the explicit period for our purposes. You'll find in some textbooks that generalize a little bit differently than that, but for our purposes, the present value of discounted cash flow is going to be a discounted cash flow during an expressly or explicitly forecast period of time. Please, Karen.
For the continuing value, you're discounting it to the year 0 of your continuation.
I am. Why? Why am I not discounting it, since I used a number here in year 1, why am I not discounting it back here into, in this case, the 5th year? Why am I doing it into the 4th instead?
That's my question, I guess.
Nicole, do you know why?
Because that's the end of your, what did you call it, explicit period?
It is, but there's something just a little bit more fundamental that actually relies on this. What is the dividend yield equation? P0 equals D1 divided by R minus G. So we said that that's the dividend yield equation is a generalized version of a basic valuation equation, which would be value at time 0 is equal to some cash flow at time 1 divided by a discount rate minus the expected growth rate of that cash flow. The key there is the value is as of time 0, but we used something as of the next period to calculate it. And since it's as of time 0 is the last year of the explicit period, that's how many periods it is from now. Why, by the way, why is the equation built some value at time 0 is equal to some cash flow at time 1, future from now, divided by R minus G? Why is that the construction of the equation? Think about it. You actually know the answer, and it's not an algebraic answer. When I buy something today, I buy a company today, what cash flows am I going to now own? The ones that exist today,
Future.
the ones in the future. Period 1 is in the future. That's why. And if you're using that generalized equation, not only is period 1 in the future, but all cash flows beyond that are expected to grow at a constant rate of growth from that one. Okay, that's why. It's probably important to be able to think that through. And so try it on a couple of times, and if you struggle with it at all, visit me, WhatsApp me, whatever it is. Let's make sure that that's kind of ground in there, kind of like the present value of beta t divided by 1 plus r. Okay? So, we talked about net present value, internal rate of return, and modified internal rate of return as being decision criteria. What's internal rate of return and what's modified internal rate of return, conceptually? Cole, what's IRR?
The rate at which you're going to grow. I know the difference between IRR and
Okay, that's important. Anybody else? What's a basic description of internal rate of return? Nickel?
Well, it's in the word, right? It's the average rate of return on your capital invested, right?
Yeah, it's the return that you actually got. Okay, so if we now have observed these cash flows, we've made this investment, and now we're assessing it, we know that we got the internal rate of return. Okay, what's the relationship between internal rate of return and net present value? Please.
Higher end being equal equals higher IRR, right?
Say that again, please.
Higher NPV equals higher IRR.
Okay, okay. I want to think about a higher NPV, net present value, using a standard of 0 though, right? So if I have a net present value that's greater than 0, so it's positive, that means the internal rate of return that I can observe or receive is greater than what? Well, maybe. The discount rate is greater than the discount rate. If my discount rate was 0, then, yeah, 0 becomes kind of problematic in that, but I think I understand what you meant. So if my internal rate of return is equal to my expected return, my discount rate, what would I expect the net present value to be? 0. Yeah, they would be 0. The net present value would be 0. When I have a net present value of 0, does it mean that I didn't make any money? What's it mean?
Means you broke even
I broke even. On what standard?
on your initial cost or investment.
Well, I earned my discount rate. I earned my discount rate. So on an economic basis, I broke even. On a nominal accounting basis, I had probably some nice profitability, which profitability was evidenced by having earned the discount rate. Please.
Is it saying that you made as much money here as you could have been making anywhere else?
If your discount rate is reasonable and is your real opportunity cost of capital, that's exactly what it's saying. Now, if your discount rate is a little unreasonable or can be interpreted to mean something else, it shouldn't be, but if it is, which it is for most investors, then it might be something a little more aggressive than that. Okay? Oh, I got the question I want to ask differently. MIR and IRR. We're going to let him come back since he knew the answer. Okay? So, I'm always assessing my net present value against 0. Remember that when I'm doing this in Excel, I have to use kind of a funky construction to find my net present value. I got to bring these rows back in so I can see all of this. And I suggested that we can think of net present value in 2 ways. I can either think of net present value as the present value of my investment, the present value of this asset based upon the discounted future cash flows for time and all for eternity, minus the present value of what my investment in them is, the cost. Okay, so that's very, very simple, very clear. Or I can calculate it in something that's a little bit more complex using the net present value equation. Okay, or function rather, in Excel. And in that net present value function in Excel, it is equal NPV, open a parenthesis, and then you grab the cell that shows you your discount rate, expressed, and you have to enter that in as point something, not as 9%, but as 0.09. And then the range of cells that shows your cash flows starting at time 1. We want to start at time 0 because we know we should be doing that, but Excel doesn't understand time 0 in this case. So our range of cells must start at time 1 and take us to the end of our explicit period. And then we have to add whatever our investment was. We add it when we expressed our investment as a negative. We'd subtract it if we were expressing our investment as a positive, right? Okay? But even within that, there's something kind of odd going on here. Because I've shown a year 4 cash flow of $750,000, but here I've got a year 4 cash flow of $65,218. What's the difference? Garrett?
Different question.
Okay.
So on the present value of the discounted cash flows of like our initial cash flows, you don't add or subtract year 0, and I'm confused why. But in this case, you are adding.
Over here?
Yeah.
Because over here, I'm simply trying to find the value of the asset. Over here, I'm trying to consider its net present value and internal rate of return and modified internal rate of return, assuming I've made some investment. Over here, finding the present value of the asset is simply to inform me what kind of investment I might reasonably make. Now that I've been informed of that, and I've agreed upon a price, now I can find a net and a rate of return. But I gotta have one before I venture into the other.
So you just wouldn't take into account the 40,000 in year zero?
No, in fact, and I did this with you guys the other day, I think, let me do it again now. I don't like that I have that there.
Oh, you took it, yeah.
Yeah, so let me do this to make it a little easier for all of us. That's fine. Now I got rid of it, so you don't have to be pestered by it, okay? So why don't we consider the cash flow at time zero in our present value equation? Why do we leave it out?
Because you already spent it.
Well, because it already exists, and it exists belonging to somebody else, not us. If we bought it today, we get the future cash flows, it already is there. Pretty though it might be, it's not ours. It might help set up what becomes ours, because I don't think it's reasonable to assume we're gonna have some cash flow tomorrow if we had no cash flow today. Okay, so there's some path dependency that might exist here. All right? So let's come back over here. Why do I have $750,000 here when I only have $65,000 here?
It's continuation value.
I'm adding to this 65,000, I'm adding the continuation value. Why am I doing it, and why am I putting it here in year 4?
Is that the start of your continuing year?
Yeah, that's times 0 for my continuation. And the equation was the value at times 0 is equal to some cash flow in the future divided by a discount rate minus G, right? So that brings it into times 0's time signature. Well, times 0 of my continuation is the same year as time 4, in this case, last year of my explicit period. Same year. So I can add those two numbers together. But there's yet one more reason. Why am I putting this number here instead of just picking up a whole series of forever cash flows, or at least some more cash flows? Zach?
Can't calculate that. Like,
Excel can't handle an infinite series of values, because you and I can't handle an infinite series of values without having given a dollar certain term to that series of values and assigning it to a point in time. So we did that. And that dollar certain term was $684,798. So we added it to the 65,218 for year 4, and now I have a finite series wherein I have 45,002, 51,000, 57,007, 750,000. I take then the present value of those based upon that discount rate. I subtract from it the initial investment, and that gives me my net present value. Simple, clean, and perfect, right? Yes, Zach?
So, like, I get why we're doing it for the 4 years, because that's our explicit period.
Okay.
But why is it calculated that way instead of adding a 5th term for the continuation value?
Why did we use 4 years instead of 5?
Yeah. Or not even 5, but, well, okay. never mind.
3, 7, 9 hike? Are you asking why 4 years for the explicit period?
I'm more asking why for the continuing value is it not a separated term? Like, I get it's added to.
Oh, thank you. Why did I not put the continuing value down here in time 5?
Right.
Because the continuing value is a value as of year 0, which year is the last year of the explicit term. And if I put it down here in another row, and then I used this range all the way from here down to this next row, Excel interprets this as 5 years and doesn't know to discount it back as the 4th year. That's why. Good question. Okay?
Right?
And, yes.
Is it normally going to be that big of a jump for your final CV? Like on, you know how it's like 57, 31, 45, and then it's 750,000? Is that expected to see that big of a jump in the final year?
Yes. Why?
Well, I get because we're adding the CV to it, and so it makes sense because it's like in this case it's that number divided by 0.1, right? And so is that always going to be the case? You do the rate minus the growth.
It pretty much is, but think about this. This number of $51,076
Okay.
is the then, in year 2, then present value of the cash flow for that year, right? So that's the present value of that cash flow if we're already in that year. It's not if we're thinking about it from today, because it's just the nominal cash flow, right? The then present value of the cash flow itself for year 4 is $65,218. But we then have to expand that by this additional present value that isn't for 1 year, it's for an infinite period of years.
Okay.
So each of these cash flows is only for 1 year. This one that we have in the last year of our explicit period, or our calculation here, represents all future cash flows wrapped into one, all of them. So yeah, you would expect that to be a much, much different number. Hopefully a much bigger number, right? If it's not, there's a bit of an issue going on.
Okay.
Please.
So if I were to take this investment, could I expect an IRR of 20.6, assuming that all our numbers are 100% correct?
Yep.
Could I expect an IRR of 20.6% or 19.96 forever? If
I understand the question you're asking, and it's a little bit hard to answer the way you're asking it, okay? So let me try to turn it around so it satisfies your need. If you purchased this investment at $460,000, and it gave you these cash flows in years 1 through 3, and then we could then generalize all future other cash flows in this number, then that would be telling you that your annualized internal rate of return for this investment that you believe will last forever is annualized at 20.6%. Which I think does probably mean you can expect that that is your long-term perpetual rate. Okay. So I think yes, but I think it's important to think about it in those terms. Okay. Now, Cole, we waited for you, buddy. What's the difference between modified internal rate of return and IRR?
The modified is going to take your reinvestment and put it towards the discount rate instead of the 20 or the rate that you're getting at the end. So
Yes.
it's like a more conservative look.
So, and I'm not going to say more conservative, although you might be able to apply that. I'm going to say more realistic, okay? I'm going to say what you just said, but a little bit differently. The modified internal rate of return assumes, in its internal calculation, assumes that all cash flows are reinvested at your discount rate. Which, if your discount rate is a true opportunity cost of capital, that would be a reasonable assumption to make, right? Should be able to reinvest those monies at your opportunity cost of capital. The internal rate of return equation, however, doesn't do that. The internal rate of return equation assumes that all cash flows are reinvested at whatever the internal rate of return happens to be. And you'll remember the other day, they said, well, okay, what if, silly, this investment that we said down here is worth $544,699. What if I was prescient enough that I could buy this puppy for $10,000? Yeah, I appreciate you not laughing. We would have calculated then an internal rate of return of 491%. Is it realistic that we can invest these cash flows at 491% when our discount rate, our theoretically accurate opportunity cost of capital, is 15%?
No.
No, we're up in the night, right? Please, Bruce.
So I get your point about how come everyone still goes with IRR when
Yeah.
it comes down. But like I see where you're coming from. I know you mentioned that you do MIRR, but how come everyone else in the finance world sticks with IRR if that's the case?
It's a great question. I don't know the answer.
Okay.
I don't know the answer. I just know the measures are separate. I know that MIRR is more accurate, assuming your discount rate's accurate, right? Is more accurate. And I know the vast majority of the finance world looks at IRR. And because of that, I said you should use it as a comparative metric. Please, good one, back to Bert.
It's also fair to note though that other industries than businesses, you just use IRR, right? So it's more like applicable to all industries. So like real estate, where you don't have a reinvestment rate, or shipping, right? If you only have a boat.
Well, no, I think that the same thing applies. Because still, an internal rate of return, when I'm thinking about it in real estate, or I'm thinking about it in shipping or anything, is assuming that these cash flows are being reinvested at the amalgamated rate that's being calculated. I think what you're saying, though, is if we have a piece of real estate and it's not spinning off a cash flow, we just have a cost today, price today, and we think we can sell it for a dollar amount in 10 years. And there's no cash flows that we're going to have in the meantime. Let's say it's just a raw piece of ground and we're not leasing it out. Then we can take the amount we sell it for in 10 years, contrast that to today, and we can find an internal rate of return, right? And in which case, it is reinvesting itself at that amalgamated rate. I think that's part of what you're saying, right? Yeah, so you do have to consider that. So in that case, yeah.
Yeah, no,
Yeah.
I
Please, Zach.
And so, just, it might make more sense to me in my head, but
Mhm.
when thinking of MIRR, and another way to say it is, for the cash flows you make on this investment, put elsewhere you can expect 50% back.
You can expect your discount rate. Yep, exactly. Please.
Just for this class, are you expecting us to go with both of them, or is it going to be just going IRR? Or?
I will always be explicit in terms of what I'm asking you to do.
Okay, for sure.
If I want MIRR, I'll tell you I want MIRR.
Okay.
Cole and then Zach.
You said yesterday there is no MIR on the calculator, right?
I don't know of an MIRR function on the calculator. I always use it in Excel. Okay. There might be a way to do it. In fact, there is a longhand version of the mirror equation. You've got it in your notes online. I'm not holding you accountable for it. You could use that equation, calculate it through, and use your calculator to do it. It's just relatively onerous, and I don't need you to memorize it, unless you really want to, and we'll go buy you a life. Zach and then Sherry.
Are there calculations we'll use, IRR or MIRR, like functions that have them as a part of it, like a calculation where we have to use that number, or is that more for just analyzing and like determining?
Great question. I think that either the internal rate of return value or the MIR value are end results. I can't think of a situation in which they are inputs to some other outcome. Not that I can immediately think of. Sherry?
So if you click on MIRR, it actually asks you like your finance rate and reinvest rate.
Mhm.
So do you will ask us like in some kind of problem that you will give us two rates or just one?
Good question. We talked about this a little bit the other day, but I think by then some of your brains were a little bit fried out, okay? In Excel, the MIRR function asks you to first put in the string of values, which ironically, when we use IRR or MIRR function in Excel, it does understand time zero. But it doesn't understand it in the NPV function or the PV function, either one. So it wants to know whatever our string of values are, and then it wants to know our finance rate and separately a reinvestment rate.
So is your finance rate simply means your discount rate?
Yeah, in fact, the finance rate is the discount rate, the reinvestment rate is whatever you think you can be reinvesting at, and if you gave an accurate discount rate, it should be the same rate, okay? Now that gives you a hint to the complexity of the actual longhand equation, okay? In the actual longhand equation, you get to use rate in two different parts of the equation. And so, since you have it in two different parts, it theoretically could be two different rates. I will always seek to apply it as one rate. In fact, Ryan knows I'll always use it as the discount rate. And I think you should too. If your discount rate really is the rate at which you can invest, it is both your finance and your reinvestment rate.
And I have another question. So if you double click on IRR, it asks you values and guess. What does guess means? What are you guessing for? I know it's optional, but
Huh. I don't know. Never used that. So the equation is equals IRR, open the parenthesis, and I simply then pick up, the string of values. I don't give another value. I don't know what that guess is. I apologize. Okay? So these are decision criteria. If I have a requirement of a discount rate, I want to know what my net present value is because it tells me whether I got that discount rate, right? If I have a requirement of some rate beyond it, maybe I want to know what the internal rate or the modified internal rate is because it lets me decide whether I want to invest in that investment. Maybe another decision criteria is the actual dollar amount needed to put in. If Brigham today came to me and said, hey, Rick, here's a good investment opportunity at $10 million, it will certainly make you a gazillionaire, I would simply have to say no because I don't have $10 million in cash today, okay? Or Mason came and said, here's an investment that will make us all wealthy without any ifs, ands, or buts about it, but the money's got to be invested for 25 years. I'm going to say, ask my children, right? Because probably I'm not the one that should be making that decision with money that would otherwise end up having to be theirs because 25 years from now, not a great likelihood that I'm going to be with y'all. Okay, that's a little far north of what my expectation might be, right? So yeah, decision criteria. So you have to think about this. And we talk about one of the decision criteria being the length of time that it takes to get paid back. So now let's shift this gear, and I'm going to go to a different spreadsheet that's not linked for you on Canvas yet, but will be within the next few hours. I have it ready, I just haven't linked it. And it's called From EV to Market Equity. So when you go look for it, and what I want to do is I don't want to spend much time talking about this construction because this construction is the exact same construction you just saw in the other one. Literally identical aside from I'm using different inputs which give me different outcomes, but the construction is literally the same construction. But now I want to think about if I'm looking at this valuation, how do I bring that back to the value of the common stock or maybe even the value of the preferred stock? Okay? So think about this. If I have estimated a present value, and let's assume for a moment that I'm actually going to pay that present value. So let me put up here the same number, 3926604. So if I'm actually going to pay that present value, I've now estimated the enterprise value of the asset. I've estimated a dollar value that I would have to pay today to own all the rights to all the future cash flows, including the cash flows that might otherwise go to the common shareholders, might otherwise go to the preferred shareholders, might otherwise go to the debt holders, minus the cash, because as soon as I own the asset, I own the cash and it offsets part of my investment. That's the enterprise value, okay? How do I now go from that enterprise value number, which let's say is $3,926,000, how do I go from that number to thinking about some number that is my equity value? So to do it, I'm going to have to go off of the screen here for a second. Can you see this without me changing the lights? See it well enough? Okay. So if enterprise value is equal to market cap of common plus market cap of preferred plus the market value of the debt minus cash. If that's the case, how do I, and if I know enterprise value because I just calculated it, how do I now bring this into where I can just think about what the equity value is?
Subtract debt and add back.
It's an algebraic equation, right? So if I want to know the market value of the equity, which is the market value of the common and preferred, it's going to equal the enterprise value minus the market value of the debt plus the cash. Right? That's all it's going to be. You know, it's easy to say like that. It's all it's going to be. The cash we have on the balance sheet, right? And the debt, we've already talked about how we think about the market value of debt. If I have on the balance sheet bonds, bank loans, a mortgage, and a credit line, which of those will I calculate a market value for versus which of those will I use the book value as the market value? Bonds, a bank loan, a mortgage, and a credit line. Which will I use the book value as though it were its market value, and which will I calculate a market value for?
Calculate for the bond.
Calculate for the bonds. Now we're assuming we know the face value on the bonds, we know the coupon rate, which begets a payment, right? It's assuming we know the current yield for that kind of debt instrument in the market today, and we know how many periods of time between now and it's paying off its face value. But we know those things, and we should be able to. We calculate the market value for the bonds. What else?
Calculate your market value of your loan,
So the bank loans.
or bank loan.
If the bank loan is an interest-only loan, and I know similar elements about it, just like I do for the bond, then Mason and I know that we can calculate a value for the bank loan as well, right? If the bank loan is fully amortized and we're paying off principal at the same time we're paying off interest, it's harder to do, isn't it? Okay? And we typically don't have a full amortization schedule that says here's how much principal is being paid off and here's how much interest is being paid off, in which case we can't really give it a market value. We'd have to take it as book. What about the credit line and the mortgage? Calculate a market value, or do we take their book value as though they were market values? Take the book value as though they were market values. Why? Why do I do that with a credit line? What is it about a credit line, most credit lines, that cause me to be able to? Cole?
Because when you take that money out, you're paying interest at that time. Just because you have that credit line, you're not like taking that money necessarily.
Yes, and I think what's at the heart of what you're saying is that when I have a credit line, because I can take money out, put money in, it's a constantly fluid mechanism, the interest rate is also fluid. The interest rate on a credit line typically is daily adjustable, and it reflects the accurate rate that day for that kind of instrument. And so when it's stated rate and it's the current rate for that kind of instrument in the market is the same thing, its book value and its market value are the same thing. Because it's the difference between those two rates that sets up a change in value in using the bond equation. So yeah, what about for the mortgage? Why don't I go ahead and take the market value of the mortgages? Or why don't I even bother to calculate it? Is a mortgage a relatively complex instrument? We used to think not, right? Up until about 2007, we got lulled into a sense of simplicity with mortgages. They became so easy to get, right? So easy for everybody in the world because there's online mortgage calculators to beat the band. Most of you have one in front of you right now, and even if you don't think you do because you have your calculator and your phone and your computer and your it's just ubiquitous. So we got lulled into this sense of thinking it's easy, but think about it. A mortgage's value is a combination of the credit worthiness of the buyer, the borrower, right? The underlying value of the real estate, which is affected by interest rates, and maybe thinking about some offsetting interest rate change in value like we would for bonds. It's very complex. It's very complex. So we simply take the current book value of the mortgage, which is the outstanding balance, and we use that as though it was its market value. So in this case, if we know enough, and we should be able to calculate the market value of the debt. And we just calculated the enterprise value is synonymous with our present value, or what we paid for it, because that sets its enterprise value, right? And now we can calculate out the market value of the equities. Well, if there's only one kind of equity, let's say it's common stock. Let's say there's not two kinds here, right? There's just common stock. And if I now have extrapolated the market value of the common stock, all I have to do is find out how many shares of common stock are outstanding, right? And immediately, I now know the per share market value of the common stock. What if I have both what if I have both preferred and common stock? Well, there's another piece of information that we might have to have then. And that piece of information has to do with the convertibility of the preferred stock to common stock. Most preferred stocks, A, pay a substantial dividend compared to common, and B, are convertible to common at some point in time, based upon some ratio. So now let's take a look at the rest of this spreadsheet. So here, I've identified this present value of $3,926,000. You see it right up at the top. In this case, I've gone ahead and said that, yeah, I paid that for it, so I paid its value, so as not to complicate the issue. I've then suggested that I know some things about the long-term debt. I know the book value of the long-term debt, $1,500,000. I know that, in this case, I'm pretending it's all bonds. I know there's a coupon rate of 7%, a face value of $1,000, years remaining of 18, current yield of 6%. That sets up a change in the value of the instrument, periods per year of 2, and that gives me a market value of that debt of $1,663,000. What we did first was we calculated a per bond value, right? And then multiplied it by the number of bonds. If I have $1,500,000 outstanding on the balance sheet in bonds and they're at $1,000 per, how many bonds do I have? Right, which is 1,500 in this case, right? So once I calculated a market value per bond, I could then multiply it by the number of bonds, and I could then go ahead and come up with my total market value of debt. Did I need to calculate a per bond value first? When you look at my equation, you look down into my cell, you'll actually see that that's what I did. Did I need to? Why not, Kira? You're right.
They're gonna just give you the same number, but it's easier to work with 1,000.
Well, it's easier for me to work with 1,000 because I have a pretty little head, okay? And 1,000's a lot easier for me to work with because it's a nice round number, it's small, okay? But I could have simply said that the face value is $1.5 million, right? If that's my face value, then I can calculate the payment based upon the coupon rate and periods per year, and that's then the face value I get back. I can do it all in one neat little calculation. I prefer to deconstruct it because I think in per bond units. Okay? Maybe that's because I'm a simpleton, and maybe it's because I spent way too many years waking up at like 5 o'clock in the morning to check the pre-markets for the bond market was going to open at 6:30 when I was in California. Okay? So I got used to it. Everything's on a per bond basis for me. You get the same number either way. Okay? Well, in this case, I want to find the market value of the equity. So I took my enterprise value, which I calculated at $3,926,000. I went ahead and subtracted from it the market value of the debt. I added to it the cash on hand, and it gave me a market value of the equity. But in this case, I've got 150,000 shares of common stock, and I got 50,000 shares of convertible, or preferred, which happens to be convertible at a 3-to-1 ratio. Not all preferred stock is convertible to common, but almost all preferred stock is convertible to common. And the 3-to-1 ratio is simply a number that I pulled out. Different versions of preferred are convertible to common at different rates, and some of them are immediately convertible, some can't be converted for a specified period of time, and you would not convert it unless it made financial sense to do so, right? But if it makes financial sense to do so, which means you take the preferred market price per share times the conversion ratio, and that equals the market value of the common. When that's the case, then you're good to go. When it's not, you probably shouldn't be converted. And so in this case, knowing these pieces of information and having said that it's a 3-to-1 convertible and a conversion rate of 3, I can now separate them out into the market cap of the common and the market cap of the preferred. I don't want to go into any real time showing you how I did that. You'll be able to see it when you look at the spreadsheet, but you just have to think it through logically. So if this is the market value of all the equity, and I've got 150,000 shares of common, 50,000 shares of preferred that can be converted on a 3-to-1 ratio, it's the same thing as having 150,000 shares of common plus 50,000 divided by 3, because that's how, so 50,000 divided by 3 is what, 16.67, I think, something like that, is that right? And so because the value of this preferred could be converted into 16,667 shares of common, and now I can break out to a per common share value, and then I can break out to a per preferred share value using the same conversion ratio. So that's how you think this through. You guys are all going to experience Rob Patterson in the 495 class. Some of you might be doing that already. I think one of you is. And some of you will experience Rob in the 405 class. Rob will be talking to you about common stock and preferred stock more than he'll be talking about whole firm valuation. And I show this simply to give you a bridge between what Rob's discussing and the kinds of things we're discussing. And sometimes you want to know the effect on the common stock, right? Because that's most often what we as investors invest in is common stock or mutual funds that buy them. Okay. Any questions about any of this? Please, Zach.
I guess in the labeling, so I was looking at it earlier, and you have NPV equals present value of discounted cash flows minus investment.
Okay.
And if you open that cell up, it's taking like the total present value and just differentiating that from the present value of discounted cash flows from the present value. Do you understand what I'm trying to say?
Nope.
Okay,
So here I've opened this one up.
Okay.
Okay.
You have that pulling, so that's from E23, but you have it labeled as present value of DCF, which is E.
Ah, got it. Think about this. This comes back to the value is the present value of the discounted cash flow plus the present value of the continuing value.
Right.
But isn't the continuing value really the present value of a discounted cash flow that goes from that point in the future through the rest of forever, wrapped up in a simple term? So you could generalize to say that whole thing is the present value of a discounted cash flow. That's what that's referring to. Yeah, thank you. Good question. So do you think that if I gave you a series of cash flows, if I gave you some information that would lead you to a discount rate, an information that would lead you to a long-run growth rate, if I gave you some information about the company's debt and enough information to calculate that into a market value for the company's debt, and information about the company's cash, could you tell me the market cap of the common stock? I think you can. You might have to look at this a little bit, you might have to think about, but just remember to rearrange the enterprise value equation. And beyond that, it's a little bit of information you've learned and a lot of common sense. Okay? Maybe it's only common to you because you're so advanced in your knowledge of finance. To some people, it wouldn't be common sense, right? So, I mean, somebody coming out of high school or go across campus to a humanities major, you're gonna look like a deer in the headlights. But you guys are gonna figure it out, right? Garrett?
What would be the piece of information that would let us differentiate between market of common and market of preferred?
Good question. You'd have to know the
Ratio?
that's one of them, excuse me. You'd have to know the number of shares of common, the number of shares of preferred, and the ratio at which preferred converts to common.
So,
What if preferred doesn't convert to common?
Don't you just have to
you
value it
said two
separately?
pieces, right?
You have to value it separately. It's two pieces. So if the preferred stock does not convert to common stock, can you give it a market value? Think about it for a minute. What does, if it doesn't convert to common stock, it is only preferred, and preferred only gives you the preferred dividend, can you calculate a market value for the preferred?
You have to know the price.
No, because it's just a book value, right?
No, you can give it a market value. Think about this. If I asked you, hang on just one second, Sherry. If I asked you, Garrett, I know a percentage rate something is paying you. I know how long it's going to pay you. I know how often it pays you. I know what you can expect to get when you're paid back. And I know what that kind of investment would yield in the market today, percentage-wise. That's the bond value, market value bond equation. So think about preferred that does not convert to common. The dividend divided by the market price, or the dividend divided by the original price, is the percentage rate it gives you. Its face value is the amount that it was sold at originally by the company. The number of years is a number of years that you can reasonably expect to hold it, and you can impute some kind of current yield from today's market. You value it like you would value debt. You can do it. You have to make a couple of assumptions, but they're not broad assumptions. They're relatively accurate. Nickel?
Could I just look up the market value for the preferred stock and subtract that from the enterprise value?
If it's a company whose preferred stock has an expressed market value, okay? There's two problems with that. One is that if it's a publicly traded company, you should be able to go into the markets and do that. But another is that you may realize that many companies, especially banks and utility companies, will have many, many different types of preferred shares in the market at any given point in time. We were looking at this a couple of years ago. I think Bank of America, if I remember, had like 52 different outstanding preferred share issues. So you had to figure out each one.
Then they would just,
Well, then it would be a market traded company. I don't have to calculate any of this. I just go to Yahoo, Google Finance, whatever, and have it tell me what it is. So this is using private, right? Now, you might use this to help justify what you're going to pay for something. You might be able to calculate the estimated market value of the common, compare that to the current market value of the common, and if the current market value is greater than the estimated, walk away. If the estimated is greater than the current, you have every reason to believe the current's going to rise to the estimation, buy it, right? That's how you would use this kind of in Rod's class. Nickel?
never mind.
Okay. All right. Let's look very briefly at the assignment coming at you. We are slow today. Okay. So here we are in week 4, and you've got this Excel assignment coming, in which I'm giving you a snapshot of a set of financials, income statement, balance sheet, and some market information. I give you a whole bunch of different ratios and things that you know how to calculate now. And I would like you to then convert all of this to a spreadsheet. with a single sheet. I don't want you to put it in different sheets, so there's going to be one tab, one spreadsheet. These are the numbers. This looks like a spreadsheet, it's not. It's an image. So you know what it looks like, and I don't want you to simply type all the numbers in. You know that all these ratios are a function of numbers up here, and you know how to get them. And if you don't remember how to get a few of them, you get them by the methods used in the corporate finance quick sheet that I've given you. So all of this is Finance 300 and then our class as well. I want you to take this, and I want you to recreate it in its exactness. When you do that, you'll end up here, and you'll get to a point where you have calculated taxable income, which is total income minus expenses, which gave us operating income, minus interest, which then gave us taxable income. So some places you will simply input numbers, and some places you will do addition and subtraction like you would do on an income statement and a balance sheet. On the total assets, it should be the total of the fixed assets and the current assets. So don't just type in the number, type in the equation, and here for total assets, it's the sum of whatever our assets are. So use this as a model. A model is a spreadsheet construction where you put in as few values as necessary. You only put in values that are original input values, and you let the calculator, the spreadsheet, do all the rest of it for you. So that once you've created it for this, if I give you a different set of financials, all you have to do is plug those original input values into your model, and it'll populate all of this. Okay? Which, by the way, then will ultimately lead you to populating forecasts and valuations. So over a series of 6 assignments, this being the first of them, you're going to build a large spreadsheet with multiple worksheets that let you put in some financials, the original input values, some assumptions, and it will walk you all the way through the final valuations using multiple valuation models of different forms. We're going to be building that over the next couple of months. And so these Excel assignments will be interspersed with the ICP assignments, and there's even a couple of weeks in which you've got a problem set and a spreadsheet assignment that are due at the same time. When that's the case, the problem set, the best way to figure it out is to do the Excel assignment and then use that Excel model you've created to solve the problem set. That's why I give them to you in the sequence I do. And I believe this is due a week from today. Obviously, you're going to simply load this to Canvas. You're not going to give this to me. I guess you could, but there's no reason. Okay? Any question about this? Please, Sherry.
Can you remind me what is CFFA again?
Cash flow from assets. One of the first things you learned in Finance 300 was that there's CFFA 1 and CFFA 2, which essentially is cash flow that you get from the assets, which should equal the cash flow being spent out to the asset holders, and CFFA 1 should equal CFFA 2. And if you don't remember it, and it's okay, it's right at the top of the corporate finance quick sheet. Yep. Yeah, so there's nothing that's on here that's not in the corporate finance quick sheet, or that we haven't talked about. Okay? Any questions?
So those are the answers, we just need to get to them.
Yeah, you know what they're supposed to be. You have them, you know the metrics to get there. Use these inputs and that knowledge to get you these outcomes. And make it look just like this. Okay? All right, I think we're clear. Hey, most of you weren't at the finance majors deal yesterday afternoon. Is it just because you didn't have time, you had something else going on, or you just weren't interested?
Something else going on.
Someone else.
Yeah, okay. There's a lot of food. And I thought it was really cool as Rob was talking about some of the things that they're doing, and we talked about some of the things happening in our evaluation sequences as well. So we've got some stuff going on.
Are the finance majors events going to be going on Tuesdays regularly?
No. We have one towards the beginning of the year, we'll have one towards the end of the year.
Are you guys gonna do, I know you had like some presenters last year come in.
Yeah, and that's usually motivated by individual classes, but that we then send out invitations to all finance majors through the finance major canvas page. Yeah, we'll do that throughout the year. Yep, you bet.